Right now, the financial media is practically screaming at you. They want you terrified. They want your eyes glued to the Middle East, to the Strait of Hormuz, and to crude oil blasting past $91 a barrel. And look, I get it. The headlines are scary, the conflict is real, but while the masses are panic buying energy stocks and panicking over pain at the pump, you are being led directly into a trap, the $90 oil trap. What the media is absolutely refusing to tell you today is that the real wealth transfer isn't happening in oil. The smart money, the institutions, the central banks, the billionaires who actually move markets, they aren't chasing the crude oil pump. They are quietly, aggressively, relentlessly stockpiling something else, something sitting right under your nose at $85 an ounce. I'm talking about silver, and in the next few minutes, I am going to expose exactly what the institutions are doing behind your back. Why this $91 oil narrative is a massive distraction and the one terrifying data point that proves the silver market is a coiled spring, ready to snap. If you understand what I'm about to show you, you stop being the victim of the news cycle and you start positioning yourself ahead of the greatest macro shift we've seen in a decade. But if you click away now, you can go back to watching CNBC and wondering why your portfolio is bleeding out, while the elites get richer. Look, before we dive into the tape, let's get the legal out of the way. This is my personal opinion, not financial advice. I'm just a guy reading the raw market data, while the media reads the teleprompter. Do your own research, take your own risks. Let's get into it. To understand the trap, you have to understand the players. On one side, you have the financial media and the institutional money managers. Their job is not to make you rich. Let me repeat that. Their job is not to make you rich. Their job is to generate liquidity for their institutional clients. How do they do that? By manipulating your emotions, fear and greed. Right now, the fear is centered squarely on the Middle East. The conflict between the US, Israel, and Iran has choked off the Strait of Hormuz. We've got ships halted, supplies squeezed, and WTI crude oil soaring over $91.27 a barrel. The narrative is easy to sell. Buy oil, buy defense. The world is ending. But this is basic level 1 thinking. The media feeds you level 1 thinking, so you become the exit liquidity. By the time they tell you to buy oil, because of a geopolitical crisis, the move has already been priced in by algorithms, milliseconds after the first missile was fired. Now let's look at the hero of this story, the informed retail investor. You don't play level 1, you play level 2. Level 2 thinking asks, what happens next? When oil spikes to $91, what does that do? It causes a massive immediate shockwave of inflation. Everything costs energy to produce. Everything costs energy to transport. When oil stays elevated, inflation becomes entrenched. And when inflation becomes entrenched, fiat currency, your dollars, your euros, your pounds, burns to the ground. The media wants you looking at the match. Oil, I want you looking at the fire extinguisher. Silver, now let me give you the single most critical piece of numerical data today. If you take nothing else away from this video, burn this into your brain. Right now, the US dollar index, the DXY, has spiked to 98.98. At the exact same time, the US 10-year Treasury yield has spiked by 0.13 percentage points. If you read any traditional finance textbook, it will tell you that a surging dollar and spiking bond yields are kryptonite for precious metals. Why? Because gold and silver don't pay a yield. When government bonds pay more and the dollar is strong, money is supposed to flee from metals. A surging dollar is supposed to absolutely crush silver. It should be plummeting, but it's not. Silver is sitting at $85 an ounce right now. Gold is hovering near $5,185. That's not a glitch. That is a blaring red alert warning siren when an asset completely ignores its fundamental kryptonite. It tells you that the underlying buying pressure is so violently strong that it's overriding normal market mechanics. The sheer panic and safe haven demand are so overwhelming that precious metals are holding near record highs. Despite massive headwinds from the dollar, this is the identity shift you need to make today. Stop being a news reactor who just buys whatever the TV tells you to buy. Start being a macro anticipator. The smart money is looking at that dollar spike, knowing it is temporary, and using the media's oil distraction to quietly sweep physical silver off the market. Let me tell you a quick story. Because human psychology never changes. Markets are just graphs of human fear and greed over time. Go back to the 1970s. We had massive Middle East tensions, oil embargoes, and crude prices absolutely exploding. Sound familiar? Back then, the retail crowd panicked about gas lines and energy costs. But the smart money, they realized the oil shock was going to destroy the purchasing power of the dollar. While everyone was crying about the price of a gallon of gas, A few smart players started accumulating silver. What happened to silver in the 1970s? It didn't just go up, it went parabolic. It became the ultimate hedge against a system that was losing control of its energy input costs. We are watching the exact same setup play out in real time today, March 9th, 2026. Only this time the stakes are 10 times higher because we have a supply squeeze that the 1970s never had to deal with. Before we get to the supply shock, let me know in the comments down below. Are you currently holding physical silver, or are you just trading paper ETFs? Type physical or paper in the comments right now. This is actually crucial, and I'll explain why in just a second. Okay, so we established that the $91 oil price is distracting retail from the real inflation play. We established that the $85 silver price is defying the gravity of a $98.98 index. But there is a third pillar to this, a pillar so catastrophic for the global system that institutions are terrified of it leaking to the mainstream. It's the difference between the paper price of silver and the actual physical reality. You see, every time you buy oil, it gets burned. It's gone. But silver is an industrial metal disguised as a precious metal. It is the most highly conductive element on the periodic table. Every solar panel, every EV, every defense missile currently being manufactured to fight the very wars jacking up the price of oil requires silver. And we are currently running a massive multi-year structural deficit. We are mining less silver out of the ground than the world is consuming. Period. It's basic math. But the institutions don't want you to know that yet. They want you buying SLV, the paper ETF. They want you trading digits on a screen, thinking you own the metal, because as long as you buy the paper, they can control the price. But what happens when the physical supply completely dries up? What happens when the green energy sector and the military-industrial complex realize there isn't enough physical metal left in the COMEX vaults to fulfill their orders? I'll tell you exactly what happens, but to understand it, we have to look at the single most dangerous catalyst, hitting the market next week. Welcome back. If you're still here, congratulations. You've just separated yourself from 90% of retail investors who clicked away because they'd rather watch a 15-second TikTok telling them which meme coin to buy. You are here for the truth. You are here to understand the mechanics of wealth preservation. Before the break, I asked you what happens when the military-industrial complex and the green energy sector realize there isn't enough physical silver left in the vaults to fulfill their orders. Let me give you the exact word for it. Inelasticity. In basic economic terms, inelastic demand means that a buyer has to purchase a product regardless of price. They have no choice. There is no substitute. Right now, with the Strait of Hormuz effectively choked off and the Middle East conflict boiling over, governments aren't just panicking about oil, they are panicking about national security. Do you know what goes into the guidance systems of the very missiles being deployed right now? Silver. Do you know what goes into the radar systems, the communication satellites, and the thermal batteries of advanced defense tech? Silver. The military cannot turn to the government and say, hey, silver is at $85.29 today. It's a little too expensive. Let's just use copper instead. They can't. Copper doesn't have the same electrical conductivity. Copper doesn't have the same thermal resistance. They must buy silver, whether it's $85, $100, or $150 an ounce. The defense sector is a forced buyer. This is the ultimate trap the media is setting for you. They are pointing you toward oil at $91.27. They want you trading energy stocks, because that's the visible consequence of the war. But the invisible consequence, the structural, fundamental, inescapable consequence, is the massive drain on physical silver reserves to fund defense and technology in a destabilized world. While retail is chasing the oil pump, the smart money knows that oil can be drilled, more wells can be tapped, strategic petroleum reserves can be drained to manipulate the price down. But silver? It takes a decade to permit and build a new silver mine. You cannot print physical silver out of thin air. This brings us to the biggest illusion in modern finance. The paper market. Earlier, I asked you if you were holding physical silver or paper ETFs. If you typed paper in the comments. Listen to me very carefully. For decades, Wall Street has kept the price of silver artificially suppressed by trading millions of ounces of paper silver. Contracts, derivatives, ETFs, that don't actually correspond one-to-one. With physical metal in a vault, it's a game of musical chairs. They sell 100 claims for every one actual physical ounce of silver sitting in the COMEX vaults. But what happens when the music stops? What happens when a sovereign nation, a massive industrial manufacturer, or a syndicate of billionaires decides they don't want a piece of paper anymore? What happens when they say, we want delivery of the physical metal, a run on the vault? And right now, today, March 9th, 2026, we are seeing the warning signs. Remember that major numerical factor I gave you earlier? the US dollar index spiking to 98.98, and the 10-year yield jumping 0.13 percentage points. I told you that under normal circumstances. A strong dollar and rising yields should crush silver. Silver should be bleeding out, but it's holding like a fortress at $85. Why? Because the big players aren't trading the chart anymore. They are buying the physical metal. They don't care if the DXY is at 98 or 105. They are front-running a global supply shortage. They are calling Wall Street's bluff. This is where you have to make a choice. You need an identity shift, right now. You are no longer a consumer of mainstream financial news. You are an auditor of the truth. The media needs you to be fearful. They need you staring at the Middle East, worrying about $90 oil, and feeling helpless against the tide of inflation. Because a helpless investor is a predictable investor. A predictable investor buys the top of the oil market and sells the bottom of the panic. I am telling you to look where they aren't pointing. When you see gold tearing past $5,185 an ounce, defying every traditional metric of dollar strength, that is not a coincidence. That is sovereign wealth fleeing a collapsing fiat system. And where gold goes, silver follows. But silver moves like gold on steroids, because it's a much smaller, tighter market. Silver is the contrarian play of the decade, while the masses are crying over the price of gas. The elites are quietly emptying the vaults of the only asset that can protect them. So how do you actually play this? How do you avoid the $90 oil trap and position yourself on the right side of this wealth transfer? Number 1, physical possession. If you don't hold it, you don't own it. In a world where counterparty risk is at an all-time high, having physical silver, coins, bars, rounds, outside of the banking system is your baseline insurance policy. It is financial sovereignty in the palm of your hand. Number 2, high-quality, unhedged miners. If silver breaks its historical chains and starts violently repricing to account for the physical shortage, the companies pulling it out of the ground are going to see massive margin expansion. But you have to be careful. You want miners operating in safe jurisdictions. Geopolitics is tearing the world apart right now. You don't want your mining stock nationalized overnight. Number 3, patience and iron discipline. The media is going to throw everything they have at you. Over the next few weeks, they will scream about the Middle East. They will scream about oil. They will try to shake you out of your positions with volatility. Volatility is the toll you pay for the ride to financial freedom. You have to endure the swings. You have to look at a drop in price, not as a reason to panic, but as a gift to accumulate more, before the vault is completely empty. Let me wrap this up with a reality check. We are standing on the precipice of a macroeconomic earthquake. The $91.27 oil price is just the tremors. The real quake is the death of purchasing power. You have a brief fleeting window right now where silver is still available at $85 an ounce, a price that, 5 years from now, people will look back on and say, how did we not see it? How was it so cheap? They didn't see it because they were staring at the oil trap. Don't be the person who realizes what happened. After the wealth has already been transferred, be the person who saw the data, understood the psychology, and took action. If this video woke you up, if it made you see the market differently today, hit that like button right now. It tells the algorithm to push this truth to more retail investors who are currently being lied to by the mainstream media. Subscribe to the channel and ring the bell, because I am going to be tracking this exact trade, tracking the COMEX vaults, and tracking these yield spikes every single week. You do not want to fly blind in this market. And remember, this is my personal opinion based on raw market data. It is not financial advice. I cannot hit the buy or sell button for you. Do your own research, protect your own capital, and never blindly trust a suit on television. I'll see you in the next one. Stay sharp.